Hi class, welcome to chapter 9 on business type, aka proprietary activities. So again, we're continuing our discussion of state and local governments. We've spent a lot of time talking about governmental funds. We've spent a few chapters specifically addressing a lot of the issues with governmental funds like debt service funds, capital projects funds, also how to account for the revenues and expenditures. So now what we're going to do is we've spent a lot of time on those governmental funds. Now we're going to spend a little bit of time on proprietary funds, okay? So we're going to talk about the enterprise funds and the internal service funds today. That's if you're looking at kind of those summaries, those government-wide statements, normally the two columns you're going to see are the governmental funds and then the proprietary funds, the business type activities. What we're going to focus on today is more the unusual elements of business type or proprietary activities, what kind of purposes they serve in state and local governments. As we're going to talk about later, these are accounted for on full accrual basis. So as far as the accounting for these funds, generally, this is going to look a lot like what you've already covered in your for-profit classes, right? So we're not going to spend a lot of time addressing the standard entries for business type or proprietary activities. We're going to spend time talking about what kinds of entities are proprietary, when you would be using these funds, and some of the more unusual elements and interesting things that kind of come up with proprietary activities. Okay, so we're opening it up today with a quote about landfills. Nobody wants a landfill site anywhere near them, including in rural areas. We've come to this realization that the landfill is valuable and we can't bury things that don't need to be buried. So this is one of those things, like last time we talked a lot about, water and sewage, when we've talked about the infrastructure and capital assets. Landfills are another one that we generally, I think, tend to take for granted that they exist, but it's always dangerous to make an assumption that something that you depend on for your day-to-day life, it's a dangerous idea to just assume that it functions as it should. So today we're going to talk a little bit about some of the issues with landfills. So obviously, having a place for your trash to go to is a service that most of us take for granted, and we assume exists, and that's an important consideration with governmental accounting. Okay, I'm going to go ahead and skip over that. It's just kind of where we're headed today. Okay, so proprietary funds. Okay, proprietary funds, they're used to account for governmental entities' ongoing continuing operation and activities. Why do we use them? So remember that one of the crucial elements for something being a proprietary fund is that it's going to be charging the users. In the case of an enterprise fund, it's going to be charging external users, citizens, people in the community, taxpayers, people who use whatever utility is, the water utility or the trash services. So using a separate fund, using a proprietary fund, just better facilitates the process of figuring out how much to charge for those services. And so it enhances the management of those activities. It's, like I said, especially important for the ones that are, user charge basis, right? So to compare benefits and costs of the business type activities of the government and to facilitate comparisons with private enterprises. Okay? So this is one of the interesting things about a lot of the things that we're going to talk about in proprietary activities. Sometimes these functions are carried out by governments, and sometimes these functions are carried out by private entities, and it depends in large part on exactly what type of activity you're talking about and where you are in the country. So this varies from municipality to municipality, county to county. So things like electricity, water, trash, whether those are handled by the government or by a for-profit business, it varies substantially. Like even in the same city, so city of Houston, you have several public water utilities, right? City of Houston, Clear Lake City Water Authority, all the different municipal utility districts. In Houston, electricity is generally, provided by for-profit entities. So you might have, Reliant or CenterPoint or somebody else for your utilities. So in Houston, electricity is largely private for-profit, and water is generally governmental and accounted for as a proprietary fund. In the case of City of Houston, it's a proprietary fund, but in the case of a municipal utility district or Clear Lake City Water Authority, that's those are special purpose governmental entities, so that's all that they do, right? Okay, so kind of a little bit of gray area when we're starting to talk about proprietary funds, because it does vary so substantially from location to location which types of entities are included as proprietary funds. But for today, I think the examples we probably stick with the most are, especially we'll talk about like landfills and water and sewage. Those are things that are often provided by the government as an enterprise fund, as a proprietary fund, a public-facing proprietary fund that they charge for those services. Okay, so in Houston, we're going to go into these in detail later, but just so we can kind of get where we're going, there's enterprise funds, like I said, that provide services to the public, airports, convention center, and then the combined utility system that used to be water and sewer. And then there's internal service funds. So internal service funds are set up as a separate fund so that they can do the accounting, so that they can evaluate, the costs of those services. But the only customer for an internal service fund is that same government. So for example, the City of Houston has the City of Houston Health Benefit Fund, but that's run for City of Houston employees. And the Long-Term Disability Fund, that's run for City of Houston employees. So it's a separate fund that the government breaks out in order to better manage those costs and evaluate those costs. But the only customer is the main government, so City of Houston in this case. And so that's why we'll see later on things like you end up having it being backed out when you're preparing the consolidated statements, because it's not truly a separate entity. It's a separate fund so that you can have better control over those assets and an evaluation of the charges. Okay. Why might governments have enterprise funds? That varies largely depending on, like I said before, exactly what type of activity it is. But they might have it as an enterprise fund because they're an activity that provide resources that otherwise would have had to be done by raising taxes, contributions, tuition, etc. So this isn't done anywhere, but we can just do like a thought exercise as an example. Water is a pretty basic utility. A government like City of Houston, which has a whole water infrastructure system, if they didn't account for it as an enterprise fund, if they were to account for it just as in the general fund, then they would have to raise taxes to cover the cost of the water. The advantage of putting it into an enterprise fund is then you can allocate it and you can charge the consumers based on the amount of water that they use, which seems like a more rational system than if you just pay for all the water out of the general funds, right? So normally it's set up just so that you can better allocate it and cover the costs of it in a way that's potentially more rational than just paying it out of just the general fund. You might have enterprise funds because they complement the main mission of the entity. If the entity wants control over the activity, the nature of the activities is inherently governmental. But there are times when governments choose to privatize things and not keep them as either governmental funds or enterprise funds. They decide to outsource them entirely. So for example, county hospitals, there's some county hospitals in the Houston area that have been put under the administration of the Hospital Corporation of America, which is a large, very large for-profit healthcare entity. So the county hospital, in that case, they've decided to outsource the management and they've basically privatized it. Same thing's true for prisons. Some prisons are privatized. For example, I know the Cleveland unit up just north of Houston, the Cleveland unit, that one has been privatized. I think it's run by Geo Group or one of the other really large for-profit prison companies. So there's a lot of different ways that these entities can be treated. They could be something that's just run out of the general fund of the government. They could be something that's run as a proprietary fund. They could be something that's outsourced to a for-profit entity entirely. And what we're going to be focusing on mainly are the ones that are not funded out of the general fund, the ones that are separated, put into a proprietary fund. They're treated like a business, but they're still under the control of the government, okay? So what are the accounting characteristics of proprietary funds? The funds are said to be non-expendable or revolving. Okay, so this one's a bit counterintuitive. That word non-expendable, I find it was challenging for me to, kind of wrap my head around it. Non-expendable doesn't mean there's no expenses, okay? So non-expendable doesn't mean they don't use the money. They definitely do. What non-expendable means is that you're not going to constantly have replenishments from the general fund, okay? So the expectation is that if something's being run as a proprietary fund, that it is basically self-funding. That if something's being run as an enterprise fund, that it will charge users, in the case of enterprise funds, external users, or in the case of internal service funds, other departments of the government, but that it will basically take in enough revenues to pay for its own expenses, and that the general fund is not going to be constantly making contributions or transfers in to that proprietary fund. That's what they mean by non-expendable or revolving. It's that it's basically self-sufficient, self-supporting, and that's the intention. The focus is on determining operating income and change in net assets. So again, all of these are kind of oriented towards the idea that it should operate like a business, it should cover its own costs. They use the full accrual basis. The measurement focuses on all economic resources. That's the definition for, full accrual basis. The recognized revenues is earned and expenses and incurred, and you do have balance sheet recognition for capital assets and long-term debt because it's full accrual, okay? So when we move out of that set of governmental funds and we move into these proprietary funds, we are leaving behind modified accrual basis. Modified accrual basis is used for those governmental funds, and now we're using the full accrual basis. So it's comparable to a for-profit business. Still a part of a governmental entity, but run more like a for-profit business. Largely, it is kind of like the financial statements are kind of like a hybrid. They're going to look a lot like the statements for a for-profit entity, but obviously we don't have shareholders. So when you have assets minus liability equals net position, you're not going to have any external stakeholder equity. Even though it's run like a business, it's still completely within the purview of the government. So the statement of net position, similar to the balance sheet, you're going to have 3 categories of net position: net investment in capital assets, restricted net position, and unrestricted net position. For statement of revenues, expenses, and changes in fund net position, that's basically just going to detail what happened in that period, what went in and out. And the one statement that we're going to spend a little bit more time on is the statement of cash flows, because this one is a little different. The statement of cash flows is going to be prepared in conformity with GASB standards rather than FASB standards. So it's going to include cash and cash equivalents. Okay, so that's one of the key things, and we'll talk a little bit more about. So statement of cash flows. Statement of cash flows are required for proprietary funds, but not for governmental funds. GASB statement number 9. Under GASB statement number 9, you'll see we have an extra category presented here in our statement of cash flows. So instead of financing activities, you split it up and you have non-capital financing activities and capital unrelated financing activities. So operating activities stays the same, investing activities stays the same, but as far as those financing activities go, you're going to split it up and you've got 2 different categories there for non-capital and capital and related financing activities. Okay, so that's kind of what we're talking about as far as the accounting requirements. Let's take a closer look at 2 of those different types. Let's take a closer look at enterprise funds and then a closer look at internal service funds. As far as enterprise funds, there's a lot of discretion about when to use an enterprise fund. So you can see here, City of Houston has 3 major enterprise funds. City of San Francisco has 8. Atlanta has 2 major ones and some non-major. City of New York has no enterprise funds. Instead, they've set up public benefit corporations, and Chicago has 5 enterprise funds. So this is something that's variable. It's not standardized. Cities are not required to, for example, put their water and sewage as an enterprise fund. That's not a mandate anywhere in GASB or in any federal law. Cities and counties and all other state and local governments have choices about what they set up as an enterprise fund. Now, there's obviously some that it's more logical to include as an enterprise fund, but they do have a lot of discretion there. However, if it's funded by revenue debt, they must use an enterprise fund. And that makes sense because if there's revenue debt, they've agreed to pay out the debt based on revenues on a particular type of activity. So if I was the bondholder, I would certainly want to know, well, what are the revenues into that activity? And so the way that you get that is you set up that separate fund so that you have an understanding of what the revenues to that activity are, and therefore like what ability they have to pay off those debts. Okay, so you must, as a state and local government, must use an enterprise fund if there's revenue debt. If by law there must be user charges. So for example, if in the city of Houston, city council has determined that by law water must be paid for by the consumer, then that would be a requirement by law, and there would have to be an enterprise fund, or if pricing is designed to cover costs. All right. We've seen a couple of examples of common types of enterprise funds. We talked about water and sewer. Those are pretty common enterprise funds. Gas and electric utilities, transportation, airports, toll roads and bridges, parking garages, golf courses, landfills, which we're going to come back to again later, hospitals, liquor stores, lotteries. Now, the liquor stores and lotteries, that in Texas, you definitely have the lotteries, but the liquor stores, that one's one that varies substantially from state to state. It's certainly not the case in Texas. In Texas, most liquor stores are, private. But in some other states, it's actually the state that runs the liquor store. So I think South Carolina, Utah, there's actually quite a few states where you can only buy liquor at a store run by that government. So like I said, there's a lot of variability with these. It depends kind of what environment you're in, what things are run as enterprise funds of the government, but that's one where you're going to get a lot of variability. Okay, so if we look at City of Houston, we see that those enterprise funds are the airport system, convention and entertainment facilities, and the combined utility system fund. Okay? So those are the ones from City of Houston that are operated as enterprise funds, proprietary funds. Okay. Let's spend a little bit of time talking about municipal solid waste landfills, because these are certainly unique, probably not a topic you've covered in any of your other accounting classes, but incredibly important for society at large and incredibly important in terms of state and local government accounting. They might be accounted in a governmental fund, or they might be accounted in an enterprise fund. Okay, so that's going to vary depending on the area that you're in and how they established it. If usage fees are charged, then it's going to be accounted for in an enterprise fund. The fees must cover all the costs incurred before, during, and after the landfill accepts waste. The after part is crucial. Landfills can actually be they can be fairly dangerous in terms of if they're not properly maintained after closure. They can have negative impacts on drinking water in the area and other negative consequences for the surrounding community, which is why nobody really wants a landfill in their backyard. So it's important that the liability associated with post-closure costs is accounted for during the life of the landfill, okay? So while that landfill is accepting trash, you want to make sure that that landfill has taken in enough revenue to cover all the post-closure costs. You want to make sure that they're going to be able to monitor that site and care for that site and keep that site safe after that landfill has been shut. So closure and post-closure costs include, equipment installed in facilities constructed after the landfill stops accepting waste. Monitoring systems are crucial to that. The final cover, oftentimes they will completely cover it over, with like dirt and sod or whatever it may be, and monitoring and maintenance. Exactly how it's accounted for depends, obviously, depending on whether it's in an enterprise fund or a governmental fund, because those funds have different bases. Remember, enterprise fund is full accrual, whereas governmental is modified accrual. So for the enterprise fund, you're going to have the expense, and then you're going to have a liability related to closure and post-closure periods. For a governmental fund, it's going to be a pay-as-you-go basis, because remember, there are no long-term liabilities presented on governmental fund statements. However, you will see it in the government-wide statements, because the government-wide statements are presented on full accrual basis. Okay, so that one's one that it just varies slightly depending on what type of fund they've decided to set that up as. Okay, so the EPA requires all municipal landfills to meet stringent location, design, and operating requirements. Operators must provide financial assurance they can properly close those landfills and provide post-closure groundwater monitoring for 30 years. They're designed to protect the environment. So the way that you're going to account for that liability is each year the landfill is basically going to estimate what their total cost is and then multiply that by the fraction that the landfill is full. So landfill capacity that's used out of the total landfill capacity, and then you're going to subtract out the amount recognized in the past to get your current liability associated with that landfill. Okay. Another thing similar to landfills are asset retirement obligations. So there are other types of utilities and services for the government that have costs associated with their closure and their disposition. Asset retirement obligations are a legally enforceable liability associated with the retirement of a tangible capital asset. Probably one of the most salient examples, although I don't think it's as big of a public issue here out in California, where they use a lot of nuclear reactors. There was always public debate about, exactly how to dispose of the wastes from nuclear reactors. So if you shut down a nuclear reactor, the elements that they used are still radioactive, so you need a place to safely dispose of them. And when you have that, you often get a lot of NIMBY behavior. NIMBY being not in my backyard, right? So everybody wants the waste to be taken care of safely, but they want it taken care of somewhere else. The problem is there's probably somebody else who lives that somewhere else. So handling those issues becomes a big public concern, and it can be a big cost to the government. Okay, that's where these asset retirement obligations come in. The ARO liability is measured as the current value of retirement outlays expected to be incurred. The liability is offset with a deferred outflow of resources, which is amortized over the useful life of the asset. So while you're running that nuclear reactor and generating power and charging users for that power, you want to make sure that you are including enough of a buffer that you can collect the money that you will owe to dispose of that asset, the costs to appropriately dispose of that asset. And that's an asset retirement obligation. Another concern that you might have is pollution remediation costs. And these can arise in a lot of different scenarios. A school district discovering mold or asbestos that they're going to need to get treated. Toxic substances from an abandoned county dump seeping into a nearby water supply. Again, these can be accounted for in either governmental or enterprise funds, and that's probably going to depend largely on what party is most affected by it. And again, same thing, for a governmental fund, only current outlays are going to be recognized as expenditures. That's consistent with modified accrual basis. It's only going to be recognized as an expenditure in the case that it is paid for out of currently available financial resources. No long-term liabilities would be recorded for a governmental fund. On the other hand, for enterprise funds, and if you record it as a governmental fund on the government-wide statements, you are going to have estimates of the costs to be incurred and an offsetting liability. Okay. Here's some example of the types of costs that might be involved with pollution remediation. Pre-cleanup activities such as site assessments and site investigations, cleanup activities such as removal and disposal of pollutants, government oversight and enforcement activities, and then post-remediation monitoring. These costs should be estimated and recognized as an expense and liability when the government knows or has reason to believe that the site is polluted, that it will be responsible for the cleanup, and that it can make a reasonable estimate of the ultimate cost. So in the example of a school district that's discovered mold and asbestos, as soon as they find it, as soon as they are pretty sure that they are going to be responsible for it, which, if it's a public school building, that liability is almost certainly going to fall on that public school district. And then once they get somebody in there, a mold remediation expert, and they've got an estimate of the cost, then they're going to need to recognize it. Okay. All right. Those were the discussions. Well, we talked about enterprise funds, and then we kind of went on a few different little divergences there related to specific issues that were likely to come up in either enterprise funds or potentially also in general funds, depending on how that area has decided to treat things. Now let's talk about internal service funds. So internal service funds are those separate proprietary funds where the only user is the main government. So internal service funds are an accounting device used to accumulate and allocate costs internally among the governmental entities, various departments, units, or functions. They provide services only to those other departments, units, functions within the same governmental unit, or occasionally to other governmental units on a user charge or cost reimbursement basis. So, like most things in life, not everything's super black and white. So it's entirely possible that, for example, the long-term disability fund that's maintained by the city of Houston, it largely is going to handle the long-term disability liabilities related to City of Houston employees, but it's possible that like another smaller local, and I don't know that this is the case, this is just a for instance, perhaps something like Clear Lake City Water Authority doesn't want to develop their own long-term disability plan because it's too expensive, and they might, you know, work with City of Houston. So technically, although they're a separate government, they might also use that long-term fund, but 95% of the transactions for that long-term disability fund are related to City of Houston employees, so it's still going to be an internal service fund. Okay? Even if you have minor exclusions, it's predominantly an internal service fund. The primary reason they're used is to gain efficiency in government operations. So instead of having a City of Houston employee health and disability accounted for in the general fund and not being able to distinguish that cost from other employee-related costs, an internal service fund is established in order to maintain better control of those funds. Okay, so some common types of internal service funds: central purchasing, storage, issuance of supplies, self-insurance pools, which we're going to discuss, central data processing, electronic equipment maintenance, printing, transportation, central post office, central phone, any kind of those support functions. City of Houston's, the two internal service funds described are related to employee costs. Okay. Accounting for internal service funds. Internal service funds are accounting entities. They're authorized by legislative approval, but they rarely have restricted resources. They're generally basically part of the general fund that have been carved out in order to have better control. Okay, they're not often legally restricted separate assets. It's normally separated out for better accounting for the costs. They must follow all FASB pronouncements issued prior to November 1989 unless it conflicts with a GASB pronouncement. The GFOA recommends that every state or local government establish clear criteria for whether an internal fund is classified as a fund in the CAFR. So that's one where, because internal service funds are basically at the discretion of the government whether they set something up as an internal service fund, GASB basically asks you, for state and local governments, please describe, how you've determined that something is an internal service fund and disclose that in your CAFR so that those financial statement users can understand which parts of the government have been separated out as an internal service fund for better control. Internal service funds, because we're still talking about, proprietary funds, internal service funds are a proprietary fund. They are prepared on the full accrual basis. Revenues are derived mainly from other government or proprietary funds. So the revenues are generally going to be billings to departments instead of like sales, which you would have for a for-profit entity. They're just going to bill the other departments. Capital assets acquired by contributions or grants must be depreciated. Revenues and expenses are closed at year-end to excess of net billings to departments over costs, or excess of costs over net billings to departments rather than to an income center. Okay. Since the only customer of the internal service fund is the government itself, the activity is presented in the fund financial statements, but eliminated in the external facing report. Okay. So because they're a separate part of the government, you will see them presented and then rolled up. The major fund requirement does not apply to internal service funds because their balances are eliminated in government-wide financial statements. So you'll see them when you're looking through the fund statements you'll see them separated out, but then the activities are going to be rolled up and rolled into the main government for the government-wide financial statements. They have a lot of discretion as far as setting pricing, and that, the pricing objectives vary. Pricing is set by local management or legislative policy. It might be something like full costs, which include both the direct and indirect, direct costs, or whatever management desires. Generally, full cost is what's used in practice. The textbook also talks about, some of the potential downsides of using full costing. If you're talking about like a motor pool, like a mechanic maintained by a state and local government as an internal service fund, a city might make the decision to go to an external mechanic instead of their city mechanic because the costs look higher, but what they're not taking into account is that there are a lot of fixed costs for the city that are going to have to be allocated across other users now, and that it would have been better off for the city as a whole for that city mechanic to have been used in the instance. Yeah, so issues with pricing for internal service funds. Yeah, the issue of potentially accidentally encouraging other departments to use outside vendors when they would have been better off using the internal service fund. Full costing effectively transfers depreciation costs to governmental funds. And then you have a lot of discretion in billing, so you can have some potential, billing games to avoid surpluses and deficits. Okay, so one other topic, which is a little, this is debatable, and you can see the authors of the book have a pretty strong opinion about this, about self-insurance. Okay, so some governments elect to self-insure their risks. This can reduce premiums, but there is some debate about, well, is it really insurance? Because the entire premise of insurance is that you have transferred risk to a third party and that you're paying a third party to accept the risk. If you set up a separate fund, you might have money to cover costs, but you haven't fully transferred that risk outside of the main entity. So there's some, the book holds pretty strongly that, self-insurance is not really insurance. It simply sets aside funds to provide for possible losses based on an actuarially determined amount. Often the government that self-insures part or all of its risk also centralizes its risk financing activities. They can use either the general fund or the internal service fund as a self-insurance fund. How to account for the self-insurance premiums? This is obviously going to depend on whether they set up that self-insurance fund as a separate internal service fund or whether that self-insurance premium is part of the, that self-insurance fund is just part of the general fund. If the self-insurance fund is a separate internal service fund, the fund paying the self-insurance records only the portion of the premium that covers actual losses as an expenditure. The self-insurance fund records only the portion of the premium that represents reimbursement for losses. They can include like a little buffer provision for catastrophic losses as an actual loss. And excess amounts are considered non-reciprocal transfers. If the government has self-insurance in the general fund, the amount of premium recognized is limited to just actual claim expenditures. They can't even include that buffer for the catastrophic losses. All right, so overall that should wrap up our discussion of proprietary funds. Like I said, we didn't actually cover too much of the technical details of most entries because most entries are going to look fairly similar to what you've seen in your for-profit accounting classes, mainly, on the accrual basis. So there's not going to be anything too unusual there. But we did discuss some of the more unusual items like landfills and pollution remediation and self-insurance. All right, take care. Bye.